The end of the petrodollar, the agreement that underpinned global trade for 5 decades, has fundamentally changed. Since the mid-1970s, the relationship between the United States and the major oil-producing nations of the Middle East functioned as the primary stabilizer for the U.S. dollar. By ensuring that oil was priced and settled almost exclusively in greenbacks, the system created a constant global demand for American currency. This meant that any nation wishing to participate in the global energy market had to maintain significant dollar reserves. For the United States, the arrangement allowed for a unique economic advantage: the ability to run significant deficits while exporting inflation to the rest of the world. However, recent shifts in geopolitical alignment suggest this era is transitioning into something else. The move toward what many call energy realism is gaining momentum across the global South and the BRICS nations. We are seeing a move away from a unipolar financial world toward a system where multiple currencies are used for settlement. Saudi Arabia's recent openness to discussing settlement in currencies other than the dollar is a significant indicator. This isn't necessarily a sudden collapse, but rather a gradual diversification of the global financial architecture. As nations like China and India settle more of their energy bills in local currencies, the structural demand for the dollar as a reserve asset begins to soften. The data from 2025 shows a continuing trend of central banks moving toward physical assets. Gold, in particular, has seen a resurgence in its role as a Tier 1 reserve asset. This is a move toward tangible value in an era of high sovereign debt. While the Western financial system remains centered on credit and digital claims, many emerging economies are prioritizing the accumulation of resources and precious metals. The outcome is functionally a bifurcated system, one side focused on the legacy paper economy, and the other focused on the physical economy. At the same time, policy discussions within the West are shifting toward the implementation of central bank digital currencies, or CBDCs. The Bank of England and the European Central Bank have moved their digital currency projects into more advanced stages. These systems are often presented as tools for efficiency and modernization. However, the capabilities inherent in these digital structures allow for a level of oversight and programmability that was previously impossible with physical cash. While the stated intent is often focused on streamlining payments, the outcome is a currency that can be integrated with broader policy goals. The tokenization of assets. A significant shift is occurring in how the world views and trades property. Major financial institutions are increasingly focused on a process known as tokenization. This involves taking a physical asset, like a piece of real estate, a gold bar, or an energy credit, and representing it as a digital token on a ledger. The industry suggests this will bring liquidity and transparency to markets that were previously slow and opaque. BlackRock has identified this as a core pillar of their future strategy, indicating that the next generation of finance will likely be built on these digital representations of the physical world. For the average participant in the economy, this change alters the nature of ownership. The concept of private ownership is increasingly being replaced by fractional interests. In this scenario, instead of owning a specific physical asset, an individual owns a digital claim on a portion of that asset. This makes the ledger the final authority on who owns what. While this might make investing more accessible, it also introduces new layers of intermediation. The relationship between the owner and the physical reality of the asset becomes more abstract. The logistical reality of a tokenized economy is that it relies entirely on the integrity of the digital infrastructure. If the rules governing the ledger change, the nature of the ownership changes with it. This is where the integration of currency and assets becomes critical. Increasingly, we are seeing proposals where access to these tokenized assets could be tied to broader compliance frameworks. It is a transition from a world of direct physical possession to a world of conditional digital access. While the West develops these complex digital derivatives, the BRICS nations continue to prioritize the movement of actual physical goods. They are focusing on the infrastructure of the real economy: pipelines, shipping lanes, and refineries. This suggests a growing divide in economic philosophy. One side is building a high-tech digital version of reality, while the other is securing the physical inputs required to keep an industrial society functioning. The outcome of this divergence will likely define the economic hierarchy of the next decade. The unit and the commodity basket. The launch of the BRICS settlement project, often referred to as the unit, represents a direct challenge to the existing Western payment infrastructure. This is not a retail currency for the public, but a wholesale tool for international trade. The proposal involves backing the unit with a basket of commodities, with a significant portion allocated to gold. This returns the world to a form of asset-backed trade that has been largely absent since 1971. By anchoring the value of trade to physical resources, these nations are attempting to shield themselves from the volatility and debt cycles of the Western fiat system. The timing of this project is linked to the increasing cost of servicing sovereign debt in the West. As interest rates remain elevated to combat inflation, the cost of maintaining the dollar-based system grows. Emerging economies are looking for an exit from a system that they view as increasingly unstable. The unit provides a mechanism to settle large-scale transactions in oil, gas, and minerals without the need for U.S. dollars or Western banking intermediaries. This is functionally an act of de-risking on a global scale. Central banks in the East have been preparing for this by accumulating gold at a pace unmatched in the modern era. This accumulation serves as the foundation for the new settlement system. It provides a level of trust and stability that paper-based systems currently lack. As gold moves from west to east, the balance of financial power shifts with it. This isn't a matter of ideology, but a matter of balance sheet reality. The nations with the largest stockpiles of the final reserve are the ones who will set the terms of trade in the coming years. The outcome of the unit's implementation remains to be seen, but the initial phases suggest a high level of coordination. This is the first time since the end of the Second World War that a group of nations has successfully built a parallel financial architecture. It signifies the end of the universal system and the beginning of a fragmented global economy. For the individual, this means the safety of the dollar can no longer be taken for granted. The financial world is splitting into two distinct zones, one based on credit and one based on commodities. The sovereign debt spiral. The cost of maintaining the Western financial structure is entering a phase that many economists identify as a debt trap. As of late 2025, the United States national debt has surpassed $38 trillion. While the headline figure is significant, the primary concern for the stability of the system is the cost of servicing that debt. For the first time, the interest payments on the national debt have reached a level where they are comparable to, or in some cases exceed, the entire annual budget for national defense. This shift in capital allocation means that a significant portion of tax revenue is now directed toward debt maintenance rather than infrastructure, technology, or defense. The logistics of this situation suggest a narrowing path for fiscal policy. When interest on debt grows faster than the underlying economy, the traditional methods of repayment become functionally impossible. This forces a reliance on central bank intervention to manage bond yields and ensure that the government can continue to auction its debt. However, this intervention often results in persistent inflationary pressure. The outcome is a feedback loop. Inflation requires higher interest rates to control, but higher interest rates increase the cost of the debt, which in turn requires more currency creation to service. Geopolitical observers note that this internal financial pressure impacts the ability of the West to project influence abroad. A nation that is consumed by the math of its own balance sheet has less capacity to fund global initiatives or maintain a dominant military presence. Increasingly, international investors are evaluating the real return on Western sovereign bonds. If the inflation rate consistently exceeds the yield of the bond, the asset is functionally losing value. This is why we see a continued move by foreign central banks to diversify their holdings away from traditional Western debt instruments and toward the resource-backed assets we discussed previously. The capture of the ancient metal, the role of gold in the global economy, is being redefined through the process of tokenization. Financial institutions are moving to create digital claims on physical gold, marketed as a way to provide retail investors with easier access to the metal. While these tokens are presented as being backed by vaulted gold, they introduce a layer of counterparty risk that does not exist with physical possession. The owner of a gold token is essentially holding a digital promise from an institution. In a period of systemic stress, the ability to convert that digital claim into physical metal often depends on the fine print of the custody agreement. Emerging trends in the precious metals market show a widening gap between the paper price of gold and the cost of obtaining physical delivery. This suggests that the market is beginning to distinguish between digital gold and the physical commodity. As central banks in the East continue to take physical delivery and remove gold from Western exchanges like the COMEX and LBMA, the available supply for private ownership is tightening. This is a move toward what is known as physicality, where the possession of the actual resource is prioritized over a digital representation on a ledger. The policy discussions surrounding these digital gold products suggest they may eventually be integrated into the broader digital identity and CBDC frameworks. By keeping gold on the ledger, the state maintains a level of visibility and control over private wealth that is not possible with physical bullion. Increasingly, proposals are surfacing that would require the reporting or even the restriction of digital gold transfers based on compliance metrics. For those seeking a hedge against the legacy system, the distinction between a token and a bar is becoming a critical point of analysis. The wealth harvest and the bail-in trap. The legal framework for managing banking failures has shifted significantly over the last decade. In most G20 nations, the era of the taxpayer-funded bailout has been replaced by the bail-in mechanism. Under these regulations, if a systemically important financial institution faces insolvency, the first line of defense is the conversion of the bank's liabilities into equity. Legally, a bank deposit is considered an unsecured loan to the bank. This means that in a crisis, a portion of private deposits could be utilized to stabilize the institution's balance sheet. While this is intended to protect the broader taxpayer, it places the risk directly on the individual saver. This transition occurs alongside the implementation of new digital transparency laws. In the European Union, the DAC8 regulations now require comprehensive reporting of digital asset holdings to tax authorities. This level of oversight is a capability that allows for more precise and automated wealth taxation. Policy discussions are increasingly focused on solidarity levies, or taxes on unrealized gains, as a way to address the growing sovereign debt. The outcome is an environment where capital is more easily identified, tracked, and, if necessary, harvested by the state. The move toward CBDCs facilitates this process. Unlike physical cash, which exists outside the immediate control of the central bank, a CBDC is a direct liability of the issuer. This allows for features such as negative interest rates or programmed expiration dates to be applied to the currency. These are tools designed to manage consumption and ensure that capital does not remain idle. While marketed as a tool for economic stimulus, the outcome is a reduction in the individual's ability to preserve purchasing power over time. The wealth harvest is not necessarily a single event, but a series of programmed policy decisions that gradually erode the private capital of the middle class. The end of private housing. The housing market is shifting from a model of individual ownership toward a system of managed rental assets. High interest rates have created a scenario where a significant percentage of current homeowners are effectively locked into their existing properties, unable to move without doubling their monthly mortgage obligations. This stagnation has reduced the supply of available homes for first-time buyers. Simultaneously, institutional capital has increased its footprint in the residential sector. In 2025, data shows that nearly one-third of all single-family homes sold in the United States were purchased by investment entities. This trend is increasingly integrated with the process of fractional tokenization. Rather than purchasing a physical deed, emerging financial platforms offer tokens representing a share in a property managed by a third party. While this is marketed as a way to build equity in a high-cost environment, it fundamentally changes the nature of the asset. The token holder does not possess the property, but holds a digital claim on its potential yield. The outcome is the transition of housing from a private domain into a financial product where the rules of the ledger take precedence over the rights of the occupant. The logistical reality of maintaining a home is also being influenced by new building mandates and energy compliance standards. Policy discussions increasingly focus on carbon retrofit requirements, which can impose significant costs on the individual owner. For many, the cost of carry, the total expense of maintaining and heating a home, is reaching a point where private ownership becomes economically unrealistic. Large-scale institutional landlords are better positioned to absorb these regulatory costs and pass them on through rental agreements. The pattern suggests a move toward a subscription-based living model, where the physical land is concentrated in few hands while the population pays for digital access. The digital identity system. The functioning of a modern programmable economy requires a centralized method of verification. Digital identity, or digital ID, is being introduced across the West as the primary operating system for this new financial architecture. In late 2025, the implementation of unified wallets has moved from theoretical discussion to active rollout in regions like the European Union and the United Kingdom. These systems are designed to consolidate an individual's financial records, health data, and carbon footprint into a single digital profile. While the stated intent focuses on security and ease of use, the capability for real-time monitoring is a fundamental feature of the design. The pattern emerging is the integration of digital ID with CBDCs to create a conditional economic environment. Increasingly, proposals suggest that access to certain services or the ability to spend currency could be tied to compliance metrics within the ID system. For example, Smart meters already allow for the monitoring of household energy consumption. If these metrics are linked to a digital wallet, the state gains the capability to apply automated price adjustments or restrictions based on usage thresholds. This is not necessarily an overt social credit system, but a form of algorithmic governance where behavior is managed through financial nudges. The logistics of this system rely on the removal of anonymity from the economy. By requiring a digital ID for all transactions, the glass house effect is achieved, where all economic activity is visible to the issuing authority. While the West builds this infrastructure, other nations are maintaining more traditional forms of exchange, creating a divergence in global privacy standards. For the individual in the West, the adoption of digital ID is functionally a requirement for participation in the modern market. The outcome is a system where economic agency is no longer a default right, but a permission-based status maintained on a digital ledger. The final banking consolidation. The banking sector is undergoing a structural transformation that favors extreme centralization. Over the last year, a significant number of regional and community banks have been absorbed by larger institutions or have ceased operations. This is due in part to the increased regulatory burden of integrating with new CBDC infrastructures and the rising cost of digital compliance. The resulting environment is dominated by a small group of global, systemically important banks. These institutions are increasingly functioning as an extension of the state, serving as the primary nodes for the distribution of programmable currency and the enforcement of fiscal policy. This consolidation also targets the management of private pension funds. Policy discussions in 2025 have intensified around the idea of directed investment, where a portion of retirement capital is funneled into state-aligned projects such as green energy infrastructure or national debt stabilization. Because the banking system is so highly concentrated, the ability of the individual to opt out of these investment mandates is significantly reduced. The outcome is the use of accumulated private wealth to sustain the declining industrial foundations of the state. It is a transition from a competitive banking market to a utility-based model where the bank's primary role is administrative. The death of the private independent bank marks the end of traditional price discovery in many markets. When credit is allocated based on policy goals rather than purely economic risk, the market ceases to function as an efficient distributor of resources. We are seeing the rise of zombie markets where asset prices are maintained through intervention rather than demand. This creates a widening gap between the paper value of the financial system and the physical reality of the industrial base. For the saver, the banking system is no longer a place for wealth accumulation, but a mechanism for wealth management, according to the priorities of the central authority. The ultimate hedge. The Autopsy of the 2025 financial system suggests that the most effective protection against the current reset is the return to physical sovereignty. As the paper West enters a phase of managed decline, the focus is shifting toward assets that do not rely on a digital ledger or a third-party promise. This is why we have seen the repricing of physical gold and silver to record levels. Unlike a token or a CBDC, a physical bar of metal has no counterparty risk and cannot be programmed or turned off by a central bank. It remains the only financial asset that exists entirely outside the digital dragnet. Beyond precious metals, the hedge involves securing direct ownership of the inputs of life, energy, and land. The pattern suggests that those who thrive in the coming years will be those who have reduced their dependence on centralized utilities and financial intermediaries. This includes investing in localized energy production and physical commodities that have inherent industrial value. Money is increasingly flowing toward jurisdictions that prioritize the physical economy. The mining, manufacturing, and farming sectors over the digital service economy. This is the great decoupling, where the real economy separates from the failing credit system. The transition we are witnessing is not the end of wealth, but the migration of wealth from the abstract to the concrete. The outcome of the 2025 reset will be a world defined by the possession of tangible resources. For the individual, the path forward involves recognizing the difference between a claim and an asset. While the digital ledger offers convenience and tokens offer fractional access, physical reality remains the only ground that cannot be deleted.